Everybody, happy Friday. This is Finance Friday. This is the show where we give you the information you need to help you grow and protect your wealth. I'm Amy Novakovich. I'm a certified financial planner and a chartered retirement planning counselor and CEO of Nova Wealth Management. Go ahead and like us on Facebook, share this video out, check out our Twitter, check out our YouTube. We have a whole bunch of resources online on our website. Anything that you can get a hold of is helpful to you. So we like to cover things that are timely, right? That are like the buzzwords of the week. And right now, I would say a lot of people are inquiring on CDs and bonds. And what are these things? I'll try to break it down very simply, and then I'll try to get a little complex and talk about where we can make some money there, where some opportunities may lie, if that's what's appropriate for you. These are not recommendations, right? Because I'm talking to a whole bunch of people. Hey guys, thank you for joining. Talking to a whole bunch of people, and I don't know where you guys are on knowledge. I don't know if you've ever even invested in bonds or CDs or bond funds or things like that. So I'm trying to give you the information so that you can then go and make those decisions based on your financial condition and situation. So let's first break it down, right? So I apologize if I'm talking really basic, but some people are not quite sure what a bond even is and why are we talking about interest rates in the market and why does it matter? So a CD is obviously at a bank. A lot of people are familiar with CDs, right? Savings accounts, they go in, you get a CD, it has a term, a maturity, maybe 1 year, maybe 3 years, right? At maturity, you get your principal back, and along the way, you get interest in the CD. A bond is similar, except a bond actually can be marketable, meaning there can be buyers and sellers before maturity actually happens. So a bond is also issued a term. And at maturity, you get your principal back as long as the company is still standing, by the way. Kind of like a bank, like a CD, as long as the bank is still standing. I guess we can talk about that since there's been some bank failures lately. But a bond is, you're a creditor of the bank. It's debt to them. Or I guess it doesn't have to be a bank. It could be a corporation. It could be the government. Bonds are issued by a whole bunch of different people. CDs are banks. So in a bond, it trades before maturity, meaning there's a value in there. So if I buy a bond today and it matures in 3 years, I could sell it in 3 months just to whoever's willing to buy it and for whatever the value. So what happens when interest rates rise? Well, what happens is a bond, like a CD, has a fixed rate for the most part. We're not going to get into super complex things right now, which there's a whole bunch of fancy CDs and fancy bonds and notes that we can also talk about. But for the most part, let's talk about just the fixed interest rate ones because that's the bulk of them. So they have a fixed interest rate, call it 4%. Now, a couple of years ago, 4% was amazing. I mean, if you could told me you got a 4% in a bond for a year, I'd have been like, absolutely, that seems great. But now, interest rates have gone up so much. So if new bonds are going for 5-6%, who's going to pay you dollar for dollar for your 4% bond, right? You're going to have to sell it at what we call a discount, which means below principal, par value, they call it. So you're going to have to sell it at a loss. So last year, bonds got hit big time. And CDs, if you got it at a bank, CDs don't fluctuate. Now, little spin here, you actually can get CDs that are marketable like bonds. Again, not super common. Like the bond market, that's how it works, unless you're buying like a savings bond from a bank. But the bond market is a huge market. I mean, trillions of dollars. So when we talk about like the bond market, or you see headlines, they're not talking about your savings bonds at a bank. They're talking about bonds that fluctuate. Maybe treasury bonds, which are issued by the government, or corporate bonds, which are issued by companies. So when you buy a bond at a fixed interest rate, the value fluctuates. A CD, if it's bought in a brokerage account or in an investment account, and let's say like me as a financial advisor, I can get CDs from all around the country. So if I buy it on the CD market, it also fluctuates just like a bond. So I'll give you an example. So if I buy a CD today, let's say, and we can get like 4.5% to 5% roughly for 6 months, and I buy a CD in Iowa. I don't know, I'm making it up. And you wanted to sell the CD in a month. I would just have to put it out in the CD market and see what you could get for it. Now, it doesn't fluctuate much if it's short term because not a lot changes in the short term. If it was a long CD, interest rates and things could change a lot. So longer CDs and longer bonds fluctuate much more than shorter term. So where you can make some money right now, where people are making money, again, not a recommendation, but where people are making money is they're now seeing an opportunity in the bond market that was really hit hard last year, right? Because interest rates went down. I actually have the numbers here. It was actually the worst year for bonds. 2022 was the worst year. Actually, the last time we saw, so long-term, higher quality, meaning like a good credit score, we call it investment grade. So bonds are ranked because you're a creditor, right? So if you were to go get a loan, you have a credit score. They run your credit score and they say, all right, well, we'll give a lower rate to somebody who has better credit. Same thing in the bond market. So investment grade is the higher credit quality, the better run companies, right? They don't have a lot of debt. They pay on time. You know, it's their credit score. It's a rating. So I'm sure maybe you've heard of like AAA rated or AA rated or triple B rated. Similar to how we have a credit score. This is how we rank or rate bonds. So investment grade, meaning pretty high quality, pretty good bonds, were down 27% in 2022. Now, you might say, well, that was what the market was down. But for bonds, that's not normal. Usually bonds are the stable part of your investment portfolio. So the last time we had that, was in 1842, and it wasn't even close. It was actually down only 22.9%. So 2022 was a very bad year for bonds. Now, they raised rates super fast. So that's why you hear all this. So hopefully this is making sense and you're understanding a little bit like, oh yeah, I guess that does make sense when they raise rates super fast. Bond values go down that aren't mature yet. If I'm going to trade the bonds, they have a value. That value went down in 2022, 27% on investment grade bonds. Long-term U.S. Treasuries, meaning government bonds, issued by the government, right? So you're lending money to the government, down 29.3%. The last time we had anywhere close, the second worst, was 1980, and it was only down 17%. So this is where the opportunity might lie. If you're looking for something outside of stocks, the bond market might have some opportunities now, not only because it was down so much, but because of interest rates now. I mean, they're now paying 5%. You can find 5% pretty high quality bonds. If you go with a lower quality bond, you might even find some 6% out there. Like, there is really good interest rates out there. So this might be something where if you do currently work with an investment advisor, or even if you don't, that you might want to look into what we call laddering bonds, which is different maturities. I forgot to share this out, didn't I? It didn't even pop up in my notifications, so I guess I'll have to do that later. But hopefully you guys are getting something out of this and you can share it out. And I don't want to go too long here, but again, I just wanted to break it down for some people that might not understand, so you can understand where the opportunity is, so it helps everybody. So we also have kind of a weird thing right now that's called an inverted yield curve. And you might be looking at me with your eyes crossed thinking, well, what the heck is that? Well, a yield curve usually just means the longer you go out for maturity, meaning a 5-year bond, or you think of it like a CD. A 5-year CD pays more than a short-term CD. So that's the yield curve. The longer maturities get higher rates. It is actually inverted right now, meaning you get paid more for staying shorter term. If you were to go longer term, you actually get less. How crazy is that, right? That doesn't even make sense to you, and we can get into on a different day on why that is. But I mean, for the most part, doesn't it make sense? They want you as an investor to keep your money short term. They don't want people tying their money up for long periods of time right now, right? So if we go out 3 months, 6 months, we're going to get paid more than if I were to go out 2 years. So my bond ladder right now looks really tight, like 3 months, 6 months, 9 months, 12 months, versus a normal bond ladder would be like a 3 month, a 1 year, a 3 year, a 5 year, maybe a 10 year. But that just doesn't make sense right now. So you do have to know what you're doing to get the best rates, because you're going to go out there and shop around, right? And you're like, what the heck? Why is a 10 year getting less than my 3 month? Now you know. Okay, so now also a difference in bond funds versus an individual bond or an individual CD that you got in a brokerage account, right? So this is an interesting concept that is sometimes hard to grasp. I'm going to really try to make it super basic. And if you have further questions, you can always email us at info@novawealthmanagement.com or just go to our website or reach out to us through Facebook, whatever works for you. But bond funds are a portfolio of bonds. So it might be hundreds, maybe even 1,000 or more of bonds. So instead of having an individual bond that has an interest rate and a maturity date, you've got a portfolio with an average interest rate of all the bonds or an average maturity date, right? So the value of the fund fluctuates and never has like a maturity date where you have principal protection like an individual bond does. So that can be good and bad, right? Obviously, on a bond fund, you might have more upside potential than just a regular bond because you just really get the interest rate, or if you bought it on sale or at a discount, you get the difference between where you bought it and then where it matures at, par. In a bond fund, you might have more upside. So you have the ability to go out and buy a bond fund that was down a lot last year or a lot right now and get good appreciation. However, the opposite is also true. There's no principal protection. So like in a year like last year where investment grade bonds were down 27%, what do you think bond funds did, right? They're down. So even though the value of an individual bond might be down, at some point it has a maturity date. It might be long in the future, but a bond fund doesn't have that maturity date where it has a guaranteed principal. So it's good and bad because the interest rates will fluctuate. So as interest rates keep going up, like we might not be done, right? They might still raise some interest rates. So as they raise interest rates, a bond fund is going to go out and get the new bonds at the new rates, and your average rate will slowly creep up. Versus if you just have your own short-term bond, it matures and you have to go out and get bonds at the new rates on your own. Or if rates were to go down, you might have what they call reinvestment risk. So you're buying a bond, and when it matures, now you have reinvestment risk of, oh no, I had this rate and now I have to go reinvest at this rate if rates go down. Whereas in a bond fund, you have a huge portfolio of bonds and you get that average interest rate. It would take time for that average interest rate to go down, right? So there's good and bad of owning bond funds versus individual bonds, individual bond ladder, or even a CD ladder. So it would be good to look into both. A bond fund also has fees, right? They have somebody who manages all these bonds. So there's fees involved. So you have to look at the return and see if it's worth the fee. You have to analyze these funds versus just an individual bond. Depends on where you're buying it. It may have a commission cost, may have a trading fee. It just kind of depends on what type of investment account you have or what company you're going through to buy it. So you have to look at the cost, the difference of both, to see which one kind of makes sense. Or maybe it is a little bit of both, so you have the best of all worlds. And again, these are so different from stock. I mean, stock is a whole different animal, but I thought it was important to go over this type of stuff right now because it is I looked at my headlines, and half of them are about interest rates and bonds and CDs, and I've gotten so many questions this week about buying CDs. So I just want to help you see, does it even make sense for you? I really want to put numbers to it. So this is where hopefully you'll share it out and get some value as well. So when you're quoted a rate on a CD or a bond, it's an annualized rate. So for instance, if I get a 6-month 5% CD, in 6 months, I'm not earning 5%. That was a 1-year quote. So I'm earning 2.5%. I'm earning half of the 5 because it was a half of a year bond or CD. So if you have $100,000 in a whole year on a 5% CD, you would earn $5,000. There's times when the market returns in 1 week 5%. Now, it obviously can go down, but my point is I'm trying to show you the differences between stocks and bonds. So stocks can move 5% in a week versus 5% in a year. They can move down too. You know, that's the difference. But you want to have different types of investments that don't move together. So that is the advantage of having both bonds and stock, is that bonds move more to interest rates, stocks move more to a lot of other information, so they don't really correlate together. Correlate meaning move together. So sometimes it can really be good to look into bonds, and bonds haven't been attractive for a long time, so this is kind of that opportune time to start looking. So hopefully you learned something today. I know I covered a whole bunch of stuff, so if I talked over your head, I'm sorry, but feel free to ask questions, and hopefully you gain some insight on this. Next week, I will actually have another guest here, our new advisor, Charlie. He will be on with me, so we'll look forward to that. We are going to try to do this next week. I know I've missed a couple weeks. I'm aware. Very sorry. But he will be here next week, and we'll cover some more stuff that hopefully is interesting. If you ever have topics, please feel free to reach out to us in the comments, info@Nova Wealth Management, or just going to our website as well and submitting an inquiry. All right, I hope you guys have an awesome weekend, and we will see you soon. Bye.